Greetings, everybody. Welcome to Liberty Call. Today is Friday, February 17th, 2023. Hope everybody's had a good week out there. Finally, the end of the week, and not the best week in the markets. Looks like most things are finishing off the week in the red, other than the Dow Jones, which somehow mysteriously got into the green by over 100 points. But everything else looked pretty ugly across the board. Things in Europe weren't very good, and same in Asia overnight. So is what it is, but if it's your first time watching, please give me some big old thumbs up, likes, shares, and subscribes. I greatly appreciate it. Let's go ahead and jump into the numbers for today. Dow Jones, like I said, was up 129 points or 0.39%, closed at 33,826. SP 500 was down 0.28, closed at 4079. NASDAQ was down 0.58, closed at 11,787. The VIX was down 0.74% today. It's currently holding at 20.02. Canada was down 0.44. Brazil down 0.67. Mexico down 0.41. Over in Europe earlier today, Germany was down 0.33%. UK down 0.1%. France down 0.25%. Euro Stoxx down 0.52. Netherlands down 0.86. Spain up 0.06. Italy down 0.37. Switzerland up 0.55 and Portugal up 0.35. Russian exchanges were both green today. MOEX was up 0.69, RTSI up 1.49. And the overnights in Asia, Japan was down 0.66, Australia down 0.86, New Zealand down 0.59. The Shanghai and China down 0.77, the SCSE component down 1.61, China A50 down 1.39, TJ Shanghai down 0.89, Hang Seng down 1.28, and the Taiwan weighted down 0.46%. So, like I said, not too pretty for trading day, February 17th, but you know, these things do happen. And with everything else going on in the world, it's not that unexpected. All right, well, let's look at the indexes for the week, see how they finished off. The, let's see here, SP 500 looks like it's going to finish the week off down about 0.43. The S&P 500 looks like it's going to finish the week off down 0.18. NASDAQ finishes the week off basically flat. Dow Utilities up 0.77. And the Dow Transports finished the week off around 0.72. So the transports and utilities did pretty good, but everything else in the red pretty solidly for the week. So let's go ahead and go out to the long-term trend, see where we're sizing up right now. So this is the beginning of last year. Again, this is the long-term downtrend we've been in. We did break the trend here in about, I guess about a month ago, but it's been pretty sideways for going on, how long is that? About 15 days. So we've been sideways for about 2 weeks now. Again, with what the Fed's doing, I know a lot of people were hoping that we'd have a lot of ugly economic reports coming out and that the jobs numbers wouldn't look good, and that would give a reason for the Fed to go and start slashing rates again and printing money, which makes Wall Street very, very happy, because then their stock prices and their portfolios go through the roof when you have easy lending. But now we can see what that's got us into over the last 2 decades, and cheap lending and cheap money has dug the hole that we're in today. Plus, hey, we got over 30 trillion in government debt that we're all responsible for now, unless the republic collapses, which I'm kind of hoping. All righty, well, let's go ahead and jump into the economic data for this week. Let's bring this up. Jobless claims came in at 194,000. Forecast was 200,000. Last week's number was 195. So still holding under 200,000 in that range for quite a while now. Let's see here. I mean, we really have not had significant jobless numbers. I'm going back over a year here, and we've been in that 200,000 range for quite a while. I guess about a year ago we were around 250. So, but those numbers look good. Continuing jobless claims came in at 1.696 million. Forecast was 1.695 million, so 1,000 over forecast. Last week's number was 1.68 million. So again, still in that same range. Again, if we look back here at the historical numbers, we've been, we've had lower over the fall and summertime, but And then even dating back to about this time last year, yeah, we were about 1.5 million. So again, things still look pretty good. It has creeped up a smidge, but I wouldn't worry about it. I know I've talked about this quite a bit. Typically, employment is a lagging indicator. Companies have to first start seeing a lot of red on their books, and then they get rid of people. So, I would expect that the jobs numbers will probably look the worst when the stock market and the economy is actually on the ascendancy. So there is usually a lag. It could be anywhere from a few months to 6 months. So we'll see where that goes. The consumer price index year over year number came out this week. We are at a 6.4 number. Forecast was 6.2. Last month's number was a 6.5. And it grew by 0.5% month over month. Last month's growth was also 0.5%. So, we're still have a little bit of stubborn inflation in there. And, I personally think the Fed is going to have to take a little more aggressive action for a little bit longer, or probably a lot longer than most people are hoping. But retail sales year over year grew at 6.38%. Last month's number was 5.89. The producer price index, which is one I like a lot better. Producer prices grew at 6%. Forecast was 5.4. So again, about a half or 0.6% over forecast. Last month's number was a 6.5. Let's see here. The month over month number, we actually grew by 0.7% month over month on producer prices. The forecast was 0.4. Last month's number was a negative 0.2, which was great. It was nice to see a little bit of deflation in the reports, but not so much this month. Housing starts came in at 1.309 million. Forecast was 1.36 million. Last month's number was 1.371 million. So we dropped by about 62 million in home starts. But again, it is winter, so it's not really that shocking. Plus with the interest rate stuff going on. And the index of leading economic indicators came out at negative 0.3. Forecast negative 0.3. Last month's number was a negative 0.8. All right, so that's everything as far as economic data. Let's bring up our market recap. S&P 500 off lows, but remains under pressure as rate hike fears dent tech. Let me bring up my notes here. The S&P 500 started Friday's trading day lower, but managed to climb back after dropping over 1% due to investors' concerns about the possibility of the Federal Reserve raising rates by more than expected. Big tech stocks were among the hardest hit, with Google parent Alphabet, Microsoft, Facebook, and Apple falling more than 1%. These fears were sparked by economic data pointing to a stronger economy and inflationary pressures, including a hot wholesale inflation report published earlier in the week. Energy stocks also fell by over 3%, led by declining oil prices, which added to concerns that further rate hikes could blunt demand. EOG Resources, Hess, and Halliburton Company were among the biggest decliners, falling more than 5% on the day. However, the earnings front offered some positive news. Deere & Company rallied 7% after the farming equipment maker upgraded its annual profit guidance and reported first quarter earnings that beat Wall Street estimates. DraftKings also lifted guidance after its fourth quarter results topped estimates on both the top and bottom line, sending its shares more than 16% higher. The company's results indicated that its business is, quote, scaling to profitability, end quote, according to Susquehanna, which raised its price target on the stock to $26 from $24 a share. On the other hand, DoorDash's shares plunged 7% after it reported wider than expected loss. However, the food delivery company's upbeat guidance suggested that it was not yet seeing any material decline in demand due to pressures on the consumer. Goldman Sachs lifted its price target on the stock to 71 from 67, but kept its neutral rating. The overall uncertainty was prompted by Goldman Sachs' statement in a note that it was adding another 25 basis point rate hike to its Fed forecast. However, the situation remains fluid, and investors are waiting for the Fed's upcoming meetings to learn more about its future rate hike plans. The market will also be watching inflation and economic data to see if they continue to support the Federal Reserve's anticipated rate hike path. All right. So everyone's still on pins and needles trying to figure out what the Fed's going to do. I think you can probably put a lot of your worries aside. We're just probably going to have a rocky market for the foreseeable future until inflation does come back as between 0 and 2%, which is what the Fed wants to have a target of 2% every year. I personally would rather see some deflation occasionally. It would be nice if cars went down in value or in cost and which would mean that our take-home income would actually go up in value. But, that is what it is. All right, next article comes from Mises Wire. Food and shelter prices keep climbing as CPI growth hits a 3-month high. All right, the Bureau of Labor Statistics released its latest U.S. Price inflation data for January 2023. According to the report, year-over-year consumer prices rose 6.4%, down slightly from the previous month's increase of 6.5%. However, January marked the 23rd consecutive month with inflation above the Federal Reserve's 2% target. Inflation has now been above 6% for 16 months. The report indicates that the increases were due to essential goods and services such as food, energy, transportation, and shelter, with shelter prices rising by 7.9% year over year in January. The only category that saw a decrease was used cars and trucks, down by 11.6%. The report shows there was no sign of inflation in shelter slowing down, with last month seeing the highest growth rate since July of 82. Meanwhile, November of 22 marked the 22nd month of declining real wages, indicating that wage growth failed to keep up with CPI inflation for almost 2 years. The Bureau of Labor Statistics report shows that January's year-over-year growth rate was the 14th largest increase in the past 40 years, while core inflation, which excludes food and energy prices, again, we never eat or drive, where was I? Has slowed slightly from September's 2022's 40-year high. January's year-over-year growth rate was 5.6%, down from December's growth rate of 5.7%. September's year-over-year growth was 6.6%, was the highest since August of 82. The report suggests that inflation rate has not fallen, as President Biden suggests, although the rate of increase slowed slightly. It is still rising both month over month and year over year. Biden's description that the annual inflation has fallen for 7 consecutive months is therefore misleading. I'm shocked. A politician full of crap. Figure the odds. Where was I? The markets disagree with Biden's narrative, as both the S&P 500 and the Dow Jones ended the day down. The markets likely fear that price inflation looks stubborn, indicating that the Fed will continue to move interest rates up. The Fed has signaled that it is ready to end its current cycle of rate hikes if it can come up with a political excuse to do so. However, with year-over-year CPI inflation still above 6%, the Fed is a long way from its arbitrary 2% target rate. The markets expect another 25 basis point rate hike in March. The report shows that the U.S. economy has not achieved the, quote, soft landing as suggested by Biden. Until there are obvious job losses that cannot be hidden or denied, the White House is likely to portray the economy as strong, and that's in quotes. Nonetheless, Wall Street is heavily dependent on easy money and wants to see inflation fall so that the Fed can begin loosening again if price inflation is seen to be slowing. This could be interpreted as an excuse for the Fed to force interest rates back down and resume asset purchases. Again, I've said this a number of times over the past few months that, the Fed and, they're whoever they really listen to. I imagine they go into Jay Powell goes into a room with all the billionaires that run all the banks in the world, and they probably tell them what to do. You're going to lower rates, raise rates, keep them the same, and they're waiting for something. I couldn't tell you what it is, but that's just my best guess on things right now. All right, last up, this is not your typical recession. BofA's Subramanian, and this comes from Zero Hedge. All right, let me bring up my notes. Bank of America strategist Savita Subramanian has stated that the United States is not experiencing a typical recession and has warned about the Federal Reserve's quantitative tightening policy. Subramanian is the head of U.S. equity and quantitative strategy at Bank of America. She has pointed out that retail sales rose by 3% in January, the largest increase since May of 21, and that credit card data also jumped in January. She said that the consumer is still strong and that it is unwise to underestimate the U.S. consumer. However, Subramanian has warned that the consumer is paying more for goods and services and that there are concerns about inflation. BofA economists have warned that the third quarter of this year will mark the beginning of a delayed, shallower, and stretched out recession that will go on into the first quarter of 2024. So that's their guess. Subramanian has confirmed that the recession will extend into next year, but that demand may not be as weak as it is typically in a recession, because the U.S. is starting the recession with a healthy balance sheets. Deposits based on Bank of America's credit card data are still higher today than they were before the pandemic. Well, that's because we pushed out $5 trillion into the economy. There's got to be some of it sitting in people's savings accounts. Subramanian also raised concerns about the Federal Reserve's quantitative tightening policy, which aims to reduce the central bank's balance sheet by selling government bonds or allowing them to mature, thus removing them from cash balances in May of 2022. The Federal Reserve announced a new cycle of quantitative tightening as the bank's balance sheets had risen to about $9 trillion. The Fed decided to allow maturing of approximately $1 trillion worth of securities without reinvestment over a 12-month period. However, Subramanian is worried that no one is talking about the quantitative tightening and that the Fed bought trillions of dollars of assets over the past 10 years, which they are now unwinding. The report from the Federal Reserve Bank of New York this month showed that Americans are slipping into more debt and finding it more difficult to make ends meet. Credit card balances rose by $61 billion to hit $986 billion in the fourth quarter of 22, exceeding the pre-pandemic high of $927 billion. Delinquencies among borrowers have also accelerated. Household debt hit a record $16.2 trillion in the fourth quarter of 22, with debt balances growing by $394 billion during that period, the biggest quarterly increase in 20 years. Meanwhile, Americans are struggling to pay bills, with 68% of Americans worried that they will not be able to cover their living expenses for even a month if they lose their primary source of income, and 57% of adults unable to afford a $1,000 emergency expense, according to Bankrate's 2023 annual emergency savings report. So, it's kind of a two-headed monster right there, where the Fed is unwinding its balance sheet. We haven't really seen the consequences of that occurring yet at this time. Plus, the American consumer is drowning in debt worse than it was before the pandemic began. So we'll see what happens. I don't think good things are ahead of us, but again, I could be completely misled and completely off base, and life could be perfect through the rest of this year, and the market could go up 20%. But again, looking at the tea leaves, I just don't see that happening. Alrighty, well, hope everyone has a wonderful weekend. If anyone needs anything from me, please go to dsafinancialgroup.com. Hope everyone has a fantastical weekend, and I'll talk to you guys next time. Adios.